Okay, let's talk about AI. The world is pouring trillions of dollars into it, betting it's the next big thing. But what if it's all just a house of cards? NYU professor Scott Galloway is sounding the alarm, and he thinks we've seen this movie before. He believes the AI boom looks a whole lot like the dot-com bubble of the 90s, right down to the same financial tricks that led to that spectacular crash. Just to give you a sense of the sheer scale we're talking about, look at this number: $1 trillion. That's what OpenAI alone might end up spending on its AI infrastructure. I mean, that's bigger than the entire economy of most countries. The spending is absolutely astronomical. But the real question is, where is all that cash actually going? And that really gets us to the heart of this whole thing. Is all this money building a real, sustainable industry, or is it something else? Is it, as Galloway suggests, just a kind of financial magic trick designed to create the illusion of growth and prop up these sky-high valuations? So how can trillions of dollars be an illusion? Well, it all comes down to this really clever and maybe a little shady financial maneuver. It's called a circular deal. And trust me, once you see how it works, you're going to start seeing it everywhere in the world of AI. Think of it like this. It's like I give you $100, but there's a catch. You have to promise to spend all of it at my store. Now, on paper, my sales numbers just went up by $100. Looks great, right? But is that real growth? Or did I just move some money around to make my business look way more successful than it actually is? And look, this isn't some abstract theory. It's happening right now with the biggest names in the game. Take NVIDIA, the company making all the chips that are powering this whole AI revolution. They invest a ton of money into a company like OpenAI. And what does OpenAI do with that money? You guessed it. They turn right around and buy NVIDIA's chips. It's this perfect self-contained loop that makes NVIDIA's revenue and stock price soar. But you have to ask, is it real? And it is everywhere. Seriously, this is not just a one-off. You see the same pattern all over the industry. Microsoft invests in OpenAI, and then OpenAI buys its cloud computing from Microsoft. Amazon plows money into the AI company Anthropic, and Anthropic buys its computing power from Amazon Web Services. It's this intricate web of deals that makes everyone's quarterly reports look fantastic, but the whole thing might be built on a really shaky foundation. This whole web of circular deals might feel brand new, but for anyone who remembers the late 90s, this is a serious case of déjà vu. To really get a grip on where this AI boom might be headed, we have to jump in the time machine and go back to the dot-com bubble. This quote from Galloway just hits the nail on the head. It really captures what he's so worried about. The late 90s were this time of incredible optimism about the internet, right? But it was also a time of what he calls late-stage boom behavior, where all these financial tricks were being used to prop up growth that just wasn't sustainable. And he believes we're seeing all the same signs today. And the parallels they're undeniable. Back in the 90s, you had companies like Cisco. They were basically the NVIDIA of their day, using the exact same circular deal playbook to pump up their revenues. The tech is different, sure. We've swapped routers and fiber for AI chips and cloud compute, but the financial engineering behind it, it's eerily similar. So we've seen this playbook before. What happens when the music stops? Well, in the case of the dot-com bubble, it wasn't a gentle landing. It was a catastrophic explosion that sent shockwaves through the entire economy. When that crash finally came, $2 trillion in market value was just gone, wiped out. It felt like it happened overnight. All that wealth that had been created on paper just vanished into thin air. Poof! And nobody was safe. Not even the giants of the era. Cisco, the NVIDIA of its time, the company that was literally building the backbone of the internet, lost 90% of its value. Amazon lost 90% of its value. The companies everyone thought were a sure thing got absolutely hammered. And the wreckage was it was everywhere. We're talking about 500,000 people losing their jobs. Companies like WorldCom, which looked invincible, just imploded in what was at the time the largest bankruptcy in US history. And the physical stuff, all those miles and miles of fiber optic cable, it was just left dark, unused, because the demand they had engineered was completely artificial. But here's the real kicker. The dot-com crash wasn't some weird one-off event. It was actually part of a pattern. A cycle that has played out with every single major technological revolution we've ever had. If you look back through history, you see the same cycle over and over and over again. In the 1870s, it was a massive overinvestment in railroads that led to a financial panic. In the 1920s, it was the build-out of the electric grid, which was, of course, followed by the Great Crash of 1929. The pattern is crystal clear. A huge, transformative technology often leads to irrational excitement and then a really painful correction. And this brings us to what might be the single most important lesson from all of this. The technology itself can be 100% real. It can be world-changing and fundamentally important. The internet absolutely was, and AI is probably going to be. But that does not make it immune to a devastating market crash fueled by bad financial decisions and insane valuations. Okay, so after that, let's call it a sobering trip down memory lane. What does this history lesson actually tell us about the future of today's AI boom? Where are we headed from here? I think Galloway frames this debate perfectly with this quote. The argument isn't about whether AI is a powerful technology. Of course it is. No one's really debating that. The real question is whether the current trillion-dollar valuations actually reflect real-world demand and adoption that's happening right now. And we're already starting to see some signs that there's a pretty big gap between the hype and the reality. Check this out. A recent MIT study found that a vast majority of corporations, we're talking 95%, are just not seeing the return on their AI investments that they expected. So the money is flowing in, but the tangible business results, they seem to be lagging way behind. And that leaves us with this one big, provocative final question. If a correction is coming, an AI winter, as some people call it, who's going to survive? Remember, the dot-com crash produced giants like Amazon that made it through the fire and went on to define the future. But it also left behind a massive graveyard of failures like Pets.com. So who among today's AI giants is building a real sustainable business, and who is just playing a part in a financial shell game? History suggests we are about to find out.